Like I had two people this week put in offers 20 to 40,000 under the list price and just said, yeah, the sellers didn't counter, so we're just going to walk away. It's like, okay, like no negotiations. It's like, they're here, we're here, and all right, see you later. Wait till next year.
You're listening to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. And now, here are your hosts, Paul Stevenson and David Warren.
Hello and welcome back to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. Just want to remind everyone, if you ever have questions about real estate, about mortgages, Dave and I are here to help. Our contact information is in the description of this episode. We'd love to chat with you. We also want to give a quick shout out to our amazing sponsors, Gertin Poirier Avocat Lawyers, Big Insurance in Westboro, Centum, and last but not least, Easy Neon Signs. If you go to easyneonsigns.ca and use the promo code TOREP, you get 20% off each and every order. David, it's December 9th today, 10th when this comes out. I feel like November didn't happen. December is pretty much half done. What the hell's going on? How are you? What's happening?
I know you texted me that earlier today. You're like, I can't believe it's the 9th. Like,
yeah.
Completely
I forced
agree.
myself
It's
to put up
ridiculous.
my holiday decorations, my Christmas decorations yesterday because I realized if I don't do it now, it's literally going to be Christmas Eve and I'll be putting the tree up, So, but yeah, no, it's good. The market there seems to be, I've gotten a few APSs this week. People I think are trying to squeeze it in before the holidays, A lot of people still shopping, but at least people I'm talking to, everyone is still looking for a deal, People are still, like I had two people this week put in offers 20 to 40,000 under the list price and just said, yeah, the sellers didn't counter, so we're just going to walk away. It's like, okay, like no negotiations. It's like, they're here, we're here, and all right, see you later. Wait till next year, So I think it's kind of that's been the 2025 vibe. It's just kind of like there's no urgency. We're willing to wait. I know we have some numbers with regards to like predictions for 2026 from some of the larger brokerages, but we've seen the rates tick up this week from most lenders. Some without telling us, some telling us. But most lenders are now kind of pushed over that 4% for fix, and that's due to the kind of bond spiking. And I know you wanted to touch on that quickly.
Yeah. I know last episode, we were kind of speaking about the bond market being affected by outside influences. Last week, we kind of touched on what the Bank of Japan was doing, and that kind of bumped our bonds by 9 basis points. On Friday, we saw our bonds jump 19 basis points at opening of the trading day on Friday, led by the jobs numbers, really. We saw the headline job numbers come in a lot higher than expected. There was an estimated loss of 5,000 jobs, and we came in at 66,000 jobs, and the unemployment rate dropped. They were expecting an estimate of 7%. But it actually dropped to 6.5%. So at the headline, overall, from what was expected, that really was a shock and a surprise. And so that's what led the bond market to jumping. Now, the numbers, when you kind of dive into them a bit, some of them at a high level, great. I mean, we've had a 3-month run of 180,000 jobs added, which is uncommon, aside from like the pandemic rebounds. But the job mix is still a little bit questionable. Part-time youth employment dominated that number. So 93% of the headline job gains came from 15 to 24-year-olds. So that made up 93% of those gains. And it was part-time youth employment.
Which had been taking a big hit too, right? Like every time we looked at the numbers, that was the biggest demographic that was actually suffering from no jobs.
For sure.
Yeah.
For sure. I mean, the thing though is that they're not the people paying mortgages.
No, of
they're
course.
Not the people investing into the economy or investing into the market. And so, I mean, it's good for that segment to obviously see employment gains, but that's where kind of diving into the numbers sometimes can really help. But the new full-time jobs for the 25 and over crowd were what was limited, and instead they shed 18,000 of them in that segment. It was, at a high level, really a great ad, and it's good to see our employment rate drop. Good for the overall economy, not so good for mortgage rates. So we saw the bonds skyrocket 19 basis points. They opened again on Monday and jumped another, I believe 5 or 7 basis points. So, what did that end up happening? We saw the exact same thing happen with banks at midnight on Friday, that a lot of them jumped 25 basis points, 20 and 25 basis points for a lot of the insured mortgages being in that 409 to 424 range on a 5-year fixed, going from 389 to 404, kind of actually, ticking up. So for those of you that are coming up for renewal this month, what I would say is if you have a renewal offer sitting on your desk or on your kitchen counter and there's a 3 in front of that number, it'd be wise to probably just accept it, because with bonds jumping like they have, banks are a lot slower to drop. They need it to come down pretty drastically. It'll need to come down about 25 basis points to be at where they were before, and it'll need to maintain at that for an extended period of time before they're going to start dropping.
Yeah, and I think that's the last 2 months, banks have been extremely aggressive on their renewal rates, and I think they might have seen the writing on the wall sooner than we did, as far as rates increasing and knowing that they can kind of secure that business at that low rate before the bonds spiked up. But I mean, there was a lot of clients that were getting offers from their existing lender that were like 15 basis points, 0.15 lower than the lowest rate I had available, or we had available, So I think banks saw that, okay, there might not be as much new business generated over the coming months. Let's retain these clients. And obviously, as the lender, much cheaper to retain a client than to acquire a new one, right? I think we were at a conference, it was many years ago, but I think the cost to acquire a new client was in the thousands of dollars, but based on underwriting and salaries and everything else, all the time that goes into acquiring that client, marketing, etc. But to retain a client, I mean, you already have them, they're already your client, you've already received that interest for 3 to 5 years, and now to retain that client and get another 5 years guaranteed of that interest, albeit it's going to be less interest, but still your net gain as a lender is going to be much higher than acquiring a new client and paying that upfront cost, right?
Yeah. Yeah. So it's something where those, you mentioning at the beginning of those clients out shopping, still looking for deals, or commenting about that, really it has been a weird year. It's going to continue being weird. And for those looking for a deal, it's not always going to be that cut and dry of that that it's going to be there. But what it has done is it has created a much larger delta between variable and fixed.
Yeah.
We actually saw some of those same lenders that jumped their rates by 25 basis points on the insured 5-year fixed, that they actually went the other way on their variable, that they actually reduced their discount to prime by 5 basis points and have a more aggressive variable rate. And again, when that spread becomes, a bigger delta, that's when, that it becomes more advantageous in cases.
Yeah. And for people listening,
variable.
I mean, those variable rates now are in the, 3.37, 3.75 range, which is, almost a half point, or in some cases, a quarter to half point lower than the fixed rates you're getting, which is, again, this used to be the norm, right? This was always kind of the case. Like when we first got in the industry, 2013, it was very common for variable rates to always be lower than fixed. And you were kind of taking that knowing that there's some rate risk in the sense that, prime could go up and your rate could increase and so on. But with the way things are trending right now, variable seems like a great option. And also, we've said this before, and just to kind of reiterate, but if you have a variable rate, you can convert that into a fixed rate. So if you do see the rate starting to climb, or if the fixed rates do end up coming back down, you can always convert that into a fixed rate in the next, 5 years, 3 years. I was speaking with a lender today, and it seems like the overall sentiment of the market is that 2026 will be a busier year. There's a few reasons for that, at least on the lender side. A lot of people coming up for renewal that bought in 2021, kind of during that huge boom, and prices were obviously higher. A lot of those people are now, larger homes in that 1.5% to 2% range are now coming up for renewal. So they're going to need that advice. And then also people that might have taken a 3-year in 2023. So we're kind of getting that double down of the 2021, 2023. But then also they were saying that they expect the fixed rates to actually come back down again in the spring. And seeing that kind of race to the bottom from a lender perspective. They were saying that they think the fixed rates will probably land somewhere in the high 3s, which to me thinks we might see the variable rates even creep down even further, maybe in the next year, maybe one more rate cut. But worth noting as well, we were talking about this before, but in the US, they have their announcement tomorrow, and it's, I think, a 90% chance they are going to make a rate cut. So it'll be interesting to see how that kind of ripples through all industries, all markets, et cetera, in North America.
Well, we have a rate cut too, Paul. Don't forget.
Yes. Yeah. Well,
however, that's a 99%, 99.99% that it's not doing anything.
If it does, I'd be very surprised. But yes. Well, I think one is a guarantee. The other's also a guarantee. Just nothing's happening.
Yeah. On a kind of continue on this, something that we were chatting about last week as well. I'll just touch on it very quickly for people being aware, because it might affect a number of listeners, is that there was another acquisition of another Canadian bank. So Equitable Bank acquired PC Financial from Loblaws. So there's a lot of people that have PC Financial credit cards, MasterCards, and banking. So they are now being absorbed under the Equitable Bank brand. They're going to maintain, separate brands initially, but over time they will look to amalgamate them. So, Equitable is buying them for around $800 million, and it's a mix of cash and shares in Equitable Bank. PC Financial will maintain about a 17% stake in Equitable Bank after the closing, but this includes PC Bank, the insurance arm, and as well the MasterCard portfolio, which has about 2 million Canadian active accounts within that credit card portfolio. So it is a pretty large acquisition. And Equitable Bank is going to maintain as the exclusive financial partner for PC Optimum loyalty program under that long-term agreement with Loblaws. So, what we talked about last week of that consolidation in the marketplace, it is kind of, fitting that obviously that a week later there's another consolidation, albeit this one I think more broader reaching, if you will, across Canada, and a brand that Canadians coast to coast kind of are used to seeing and used to seeing in the grocery stores and all of that. So certainly some changes there coming and strengthening another bank's portfolio and capital.
Yeah, and a lot of those people, like a lot of those PC MasterCards are like people use them because of the Optimum points, which then translates into like Shoppers Drug Mart and like a lot of other people. So it has kind of like a trickle effect through a bunch of different retail locations, including the financial side of it as well, right?
Yeah, so it'll just be interesting over time. Yeah, it'll be interesting over time just to see how this changes Equitable Bank's, their offering in the marketplace. They are predominantly they're an alternative lender and a reverse mortgage lender predominantly. So this will be interesting to see how this, with retail locations and things like that, how this is going to change that directive or positioning from them, and whether they're doing this to really combat what of National Bank acquiring CWB or Optimum Bank, which is one of the biggest competitors of Equitable Bank is Optimum, which is an alternative lender. I'm curious if that due to that acquisition in January, if this is kind of what spawned this potential rollout so that they have more branch locations for Equitable to position them coast to coast as well.
Yeah, and I mean, who knows? Like, I was just thinking too, like with the PC, like I found not as often, but when we were younger, it seemed that every Loblaws had a PC Financial location in it. And I think that was kind of the first of the remote, storefrontless, like electronic banks, right? That everyone, like, I remember we had clients that were looking to get bank drafts and like they had to order them and they'd be mailed to them or like shipped via UPS or something 4 days later. It was always a bit of a headache. So I think I could see even like Shoppers Drug Mart expanding. Like it seems like every organization is, like you look at Canadian Tire, like all these companies just buy other organizations and then kind of merge into one big kind of like Buc-ee's or like kind of an all-in-one store here in Canada. So I'd be interested to see if like Shoppers Drug Mart ends up getting like through PC or through that acquisition, like having more banking availability within the drug mart or how they're going to merge all those together. You never know. These things
I think it'll help with
up.
I think it'll help with Equitable Bank's branding. They do have, for those that are investors listening, they do have extremely high rates of return on their GICs and really good digital like banking offerings for like savings accounts and their rates of returns and things like that. So anyway, either way, it'll be, I think with these consolidations, it'll be interesting to see how that changes their offerings. But I mean, as we as we look at the banks and now as we look at real estate as a whole, I know you're kind of looking at and delving into the Royal LePage numbers kind of on that, what they're thinking for 2026.
Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction at Gertin-Poirier Avocat Lawyers. We love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you for an effortless client experience that opens doors. Call us at 613-744-4488 or visit our website at gertinpoirierlaw.ca. Let's get to the heart of your deal. Are you trying to grow your mortgage business? Centum has the tools and support to help you take your business to the next level. Get access to everything from free unlimited custom marketing to daily direct pay. Find out what your business can do with Centum. Learn more at joincentum.ca. Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big, protect what matters most. This episode is brought to you by Easy Neon Signs. Visit easyneonsigns.ca and use the promo code TOREP, TOREP, to get 20% off each and every order. easyneonsigns.ca, Canada's finest custom neon sign maker.
Yeah, so next week is going to be our last episode of the year. So next week, we'll basically revisit all the numbers. But for 2026, Royal LePage came out with a report. Title was Home Prices Expected to Tick Higher in 2026 Amid Market Reset. So according to Royal LePage, they're saying after a shaky 2025, the Canada's housing market is entering a reset phase with modest price growth expected in 2026. Nationally, the aggregate home price is forecast to rise about 1% year over year by Q4 2026. I wouldn't say this is like a mind-bending prediction, like a 1% move one way or the other. But they were breaking it down by house type. So they're saying single-family detached homes are expected to see a 2% median price bump, and condominiums may actually see a slight drop, about 2.5%. In the richest markets, so that would be like GTA, Greater Vancouver, they're expecting forecast to decrease, so about a 4.5% decrease in the GTA, 3.5% decrease in Greater Vancouver. And then in areas like Ottawa, which is obviously most of the people here are likely in this area, they're expecting a modest 2% aggregate price increase. So detached homes up about 3.5%, condos up 1%. And then in places like Greater Montreal, Quebec City, etc., I think Calgary was in there too, they were looking at about a 5% increase and as high as 12% in places like Quebec City. So I mean, aside from the national average, I think some of those cities like Toronto, I know has seen a real hit over the last 6 months to 12 months, especially in the condo market. But 4.5%, I mean, that's not a small decrease at all. But then you look at places like, Quebec City, 12%. So, I mean, it's a huge increase. 5% in Montreal, even Ottawa, like 2% is kind of like in line with what we normally are, right? It's usually somewhere between 1% and 4%, I would say, on average. So 2% is kind of right in that realm. So it seems like in reading this that they expect it to be like a more kind of standard market, expected market, or like normal market than what we'd see years past, right? We're kind of coming out of that pandemic era and now hopefully getting back in a more like stable market.
Yeah, it'll be interesting to see whether that inventory gets eaten up or not that's on the market. I think to your point, that 2% aggregate price increase for Ottawa, like across the different property types, is is obviously muted. But the detached homes being around 3.5% of an increase, like for their forecast, is kind of in that figure when talking to somebody. When they ask like, oh, what would be? I always find it funny when people ask this question when they're purchasing a home. What appreciation should I use? Like purchase a home when it's right for you and not like as a speculative acquisition. And but I do kind of use that 3% mark for Ottawa when kind of looking at that historical. But I always find that funny when somebody's looking at purchasing and they're kind of like asking that question up front of what they should be using for their figures. But I think kind of the big one for me is not so much in that stabilization within Ottawa and that little bit of a gain, is just more so whether those properties that are for sale that are vacant or that are rentals right now or vacant because they were rentals and somebody looking to get rid of them, offload them, if they are converted back into rentals or whether they are absorbed and what that looks like. Because obviously we still, at least from the previous numbers, we still have obviously a high number of listings on the market. So I'm just curious how that changes.
Yeah, it's amazing how the conversation shifted. Like, 3 to 5 years ago, everyone was like, people were just buying properties because they assumed, oh, it's going to go up 10, 20% in the next year, 2 years, etc. Now like a 2% growth seems like we're happy to see it. Like we're happy to see some like at least expected consistency where you can just buy a home to live in it for, 10 to 20 years, not buying it as like a speculative investment. Like, oh, I'm going to sell this in 2 years and hope to retire. So Ottawa, especially, like we're pretty insulated, as we've said. And I know we weren't going to touch on it, but like Microsoft just said they're investing like billions of dollars into like the Canadian kind of AI space and industry. So like I think, and Ottawa obviously being a big tech city, I think will benefit a lot from that. But I'm interested to see, just like with the rates potentially coming down, prices potentially going up. Like I was saying earlier today to a client of mine, like I think, not an official prediction, but at least I believe that we're probably nearing the bottom, if we're not at the bottom, as far as like where prices are. Like I can't see things decreasing much further. And after reading this article, I was like, okay, well, at least I'm not the only person that thinks this. But I think just everything has now been at least consistent and stagnant enough that people have a bit more confidence, being like, okay, it's not going to get much worse. Like we're kind of at the election's been done, the budget's been tabled, everything is kind of like past that was up in the air. So I think we should see some consistency and some like continued growth going into 2026.
It's only brighter days ahead, you'd think.
Yeah. I've been wrong before.
It's but again, it's really hard to. It'll be funny when we look at our predictions, like you said, looking at our predictions for the year next week and how off we were, whether we were right or wrong. I actually have no idea. I haven't looked into it. I haven't listened. Neither of us have. So
yeah,
and I don't have them jotted down anywhere.
Again.
We actually have to go back and listen to it. So it'll be funny to see what we thought, and to see kind of how off we are, and it'll be funny to make a prediction in January and see how off we are as well, or whether we are accurate.
On the flip side of the home prices going up, another article from Better Dwelling was talking about Canadian mortgage arrears actually climbed to the highest they've been since 2020 with rising stress among borrowers. So they were saying that new data from the CBA, which is the Canadian Bankers Association, shows mortgage arrears across Canada have risen sharply, so reaching levels not seen since 2020. National arrears rate hit 0.24% in September, so that was up 4 basis points. In absolute numbers, it means 12,040 mortgages were 90 plus days past due, which is like pretty severe. Like we were talking about this many times, that people usually pay their mortgage first. So if you're 90 days or 3 months past due on just the mortgage, like you're probably in a much more dire financial situation, right? That was a year-over-year increase of 17.8% and a 63% increase compared to the mid-2022 low. So compounding the concern, the total number of mortgages held by CBA member banks has fallen. So roughly 150,000 fewer mortgages than their peak. While 0.24 is still low historically and far from a crisis, the trend direction, so rising arrears and shrinking mortgage pool, suggesting increasing financial stress for some households and a potential warning flag for lenders and the market broadly. And we touched on this last week, just talking about, or maybe it was 2 weeks ago, lenders being much more like stringent on verifying income. They're doing like triple checks, double checks. Like they're really taking deeper dives into all this information to make sure that the people they are taking on as clients, and the people they are lending this money to, are not going to fall into this kind of 0.24%. Now, obviously still a very low number, but when you talk about 12,000 mortgages, like that's a pretty large number of people that are 90 plus days past due.
Yeah, we saw that in, again, I don't remember how many episodes it was ago, but when we were looking at the big banks' annual returns or financial filings of that increase in loan loss provisions that they were allocating, was speaking to this exactly what Better Dwelling is talking about, just that sheer number of delinquencies and their expectation of that increasing, or people having to default, which really shows you there is a disconnect between like that unemployment rate coming down and what the banks are actually seeing, because they're the ones that have full visibility into the Canadian banks or Canadian populations, like income stream, cash flow, savings. They have those data points, and that Canadian Banking Association. So certainly something that I think will hopefully not rear its ugly head in 2026, or that things won't progressively get worse.
Yeah, and I think there's also been, like, from a mortgage specific standpoint, I do think we may continue to see tighter underwriting guidelines, but also, like I was speaking about this with a lender earlier, that there's been a lot of people that didn't renew their license in 2025, mortgage agents. So I think the quality of brokers that have remained in the industry is still strong. There's not a lot of people I know that just like entered the industry in 2025 thinking like, oh, this is going to be like a really great career move. I mean, we've been fortunate enough to be in the industry for, 13, 14 years now. So we have that experience and we've kind of seen the ups and downs in the market and rates and everything else. But all this to say, like, I think the industry itself is tightening, like to make sure that they can mitigate some of the fraud, the delinquencies, and so on.
It's, to kind of put context to that figure of defaults, the current population of Carleton Place is roughly 14,000.
There you go.
So that's virtually the entire town of Carleton Place being in default of their mortgage. Just to put just to compare.
It's a lot of people.
Yeah. A lot of households. And that's actually, sorry, correction, that's population. So that's 2 people per household.
Yeah.
So that's 2 Carleton Places, roughly.
Yeah.
That would be that are fully that are in default of 90 days plus. But just to provide a visualization or context to that figure. Well, I think we've been a little too negative this episode. I think we need to maybe slide into some mood boosts.
Okay, here we go. Number 1, went to the aquarium this weekend, but I didn't stay long. There's something fishy about that place. Number 2, what do you call a sheep who can sing and dance? Lady Baba. Lady Baba. I thought about doing the actual sheep Bob, but I'm not doing that. I embarrassed myself enough with these. I'll be back better. I'll get some Christmas ones for next week.
Yeah. Let's do better.
December 17th will be our last episode of 2025. We'll review our numbers. We'll obviously talk about what's happening in the market. And I'm assuming no rate cut. And we'll be back and we're ready for another year. And if you're listening to this, throw some questions in the comments, wherever you're seeing it. We'll answer all of them. We'll kind of do a year-end wrap-up. And thanks for listening. Thanks again to our amazing sponsors, Gertin Poirier, Avocat Lawyers, Big Insurance in Westboro, Centum, and Easy Neon Signs, easyneonsigns.ca. Thanks, everyone, for being here. We'll be back next week.
Deuces.